Hey, what's up, everyone? This is Tyson Agasaka with Portfolio Planning, and this is Investment Chats. We like to do this a couple of times a year to bring in some of our preferred portfolio managers and really talk about what they're seeing, what's happening, what could be coming in the marketplace. And today we have the very special privilege of having Brent Smith from Kinsted Wealth, one of our preferred partners. Brent, welcome. Thank you for coming on and doing this.
Thanks for the invite. I always enjoy our conversations, Tyson.
Yeah, I love talking about this stuff. So we've had quite the year so far this year. A lot of excitement, a little bit of geopolitical instability. Things are on, things are off very quickly.
Mhm.
Um, what were you guys talking about around the table, like end of the year last year? What were you kind of like looking at as maybe some red flags, and did any of those predictions come true?
We were, I don't think we saw any red flags. We were still pretty, I mean, except for valuations in the public equity markets, which we still have concerns over that. But everything else was fine. We weren't overly concerned about anything geographic, from a geopolitical perspective. And then, you get into the first quarter and, shit hits the fan. You've got the war in Iran, all of those things and that really impacted the markets in the first quarter. And so at the end of the quarter, we were still a bit, you know, pessimistic. And then what happens in the second quarter? We get the best quarter in something like 20 years on the S&P 500. So
Yeah.
it feels like the markets generally have shrugged off any of the geopolitical concerns out there. You look at the war in the Middle East, which has driven up the price of oil, which has an effect on inflation. Inflation historically has been negative for economies and the stock markets, and in this case, it really hasn't. So, I think there's a couple of things that were positive, had a positive impact, especially on the equity markets, earnings growth. And I'm going to focus usually on the U.S. when I talk about markets because it's the largest equity market in the world, and it's I think 70% of the MSCI world is U.S. So if you're going to
Yep.
talk about equity markets, you got to talk about the U.S. and earnings growth has been really, really strong, or was very strong in the second quarter, which had a big positive impact, I think, on the markets. Um, Analysts' expectations, they're still building in strong growth for the companies they follow. So that had a very positive impact, I think, or a stabilizing effect on the markets in the second quarter.
Interesting. Yeah, it's quite the year, and we've been bringing more and more DIY investors under the umbrella, just because it's so hard to. I think it's so hard to have the wherewithal to withstand the headlines, the market cycle that it seems like it should go one way and it's not.
Mhm.
And so I think professional management coming in really it really puts like a stabilizer on everything, and it allows people to focus on their life and not.
Yeah. Plus, we bring in a much more diversified approach to portfolio management as opposed to your typical, not all, but a lot of do-it-yourselfers tend to, they look at what the markets are doing and follow the trend, etc. And they tend not to be overly, or they tend not to be diversified. Listen, diversification works against you when markets are just going up 25% a year. Why would you even want any diversification? And it really is, and I don't want to call it just an insurance policy, because I think our approach that we employ is a great approach to wealth management, if you will, over the long term. But there's going to be periods of time where our approach, because we are diversified, we will underperform DYI or if they're just in, the S&P 500. But, you want a diversified approach in times of market stress, right? That's when that kind of quote unquote insurance policy really pays you.
Yeah, absolutely. And so, like from our point of view as professionals, we look at that and we employ a diversified approach even in good times. But for somebody who's a DIYer or maybe just getting started in investing as well, when what would be indicators to them that the tide is going to turn and maybe they should leave their concentrated positions, right? Like everyone says, buy the index, set it and forget it, which I don't believe. But and then you want to have some stabilizers, some feet on your stool, which is diversification.
Mhm.
What sort of flags should they be looking for?
I we've been looking at the valuations in the public equity markets for the past 3 to 4 years, and they're at extreme highs, right? Like,
Yeah,
I don't believe that if you just look at the S&P 500, that it's traded at this high of a PE multiple ever, and but it's been doing that for the past 3 years. So, I don't think that there's any real indicator of when you should be looking to maybe get out of your concentrated positions, take a more broad approach to portfolio management. But all I can tell you, okay, I'm going to tell you that there will be a bear market at some point. I don't know when that's going to occur, but it will occur.
yeah,
There's never been a time in history where we have not. Listen, it's been, forget about 2020, which was not a true, bear market driven by the financial system or the economic system. 2022, yes, there was a bit of a bear market, but it came back relatively quickly. There hasn't been a true, not just a true bear market, but an economic cycle, a true economic cycle since probably 2009,
yeah,
2008, 2009. That's 17 years where we haven't seen a true economic cycle where you got the boom and bust every 5 to 6 years, or a bear market that takes 3, 4, 5 years to get back to where we were prior to the bear market. I truly believe it will occur. The unknown is, when is it going to occur? I
yeah,
don't know. No one really knows, right? And but it will occur at some point. And are you going to be prepared for that when that happens? And typically, the average do-it-yourselfer is not prepared for it. I just think back to 2000, was it 1999, 2000, when Nortel was the largest company on the TSX. It was probably
yep,
40% of the index at one point. I think it peaked at about 130, I don't know, 140, and it's going down. It's going down. What is it DIY are doing? They're continuing to buy it back because it's cheap now. It's gone from 140 to 100 to 80 to 70 to 60, and they keep buying it back because it's going back to its all-time highs. Well, eventually it went bankrupt. We know the story there. But the DIYer has a hard time taking losses. They always believe the markets will come back in a very short term, in a very short period of time. Buy the dip, and that's what a lot of DIYers are doing. And listen, it's a lot of them have done exceptionally well. But at what point do you start looking at the markets and going, geez, valuations are really stretched from a historical perspective. Maybe I should be taking a bit off the table, or maybe I should be diversifying into things that might do a bit better, or won't do as poorly if we do see a bear market, right? I mean, a lot of people, and I'm sure you've got a lot of viewers who have been in the markets for a long period of time, and they've experienced bear markets. But a lot of newer investors don't recognize, or don't remember that was a there was a period of time I took. I think it was from say 2000 to 2013 for the markets to get back to where they were in 2000 or 19, probably 1998, something like that, because you had
Yep.
this massive bear market, and then markets eventually recovered, and then we had 2008 happen, and then so there's something that they call the lost decade, where the stock markets did essentially zero for a decade.
Yep.
Right? I'm not saying that's going to happen, but there's possibilities that it can occur due to stretched valuations, and maybe the economic growth gradually slows down. So still to be seen.
Yeah, it's very true. It's funny that investors tend to have a very short term memory, and it's usually either extremely optimistic or extremely pessimistic. And
One of the
you
two.
know, yeah, they get rooted in their point of view.
Yeah.
Um, so, in the portfolios with Kinsted, you guys have had some extreme success stories in the last little while. And one of the really most exciting ones this year was a private equity holding that did end up IPOing and did very, very well. And you guys had that in your portfolio for quite some time, like years. Do you want to talk a little bit about the story of like how that starts, what the process is, and then when it works, what it means for investors?
I'm assuming you're referring to SpaceX, Tyson.
That is the exciting one.
Yeah, yeah. We got access to SpaceX. The first piece we bought, it was in a fund where SpaceX was the largest holding. We were pretty bullish on SpaceX. This is going back in late 2020, early 2021, 5.5 years ago, and we're very um, positive on the space economy. And I think that SpaceX was the leader and still is the leader. And so we got into a fund back in 2000, early 2021, when SpaceX, I think it was about 60% of the fund that we got in at that point. And subsequent to that, there was a lot of exits in that fund where SpaceX became probably closer to 90% of the fund. But the valuation of SpaceX at that time was about $34 billion, and today it's 1.7 trillion dollars or something like that, depending on the day in question. And our second piece was about 2023, and SpaceX enterprise value was about, or market cap was about $134 billion. So it's still significantly below where it is today. So, we've done exceptionally well on that. Our clients have really benefited from that. Any of your clients who are investors with us saw a pretty significant spike in valuation at the end of June. What went public June 12th, I believe, and for a couple of weeks it did exceptionally well. And we've seen it sell off pretty significantly here over the past little while. I don't know where SpaceX is going long term. I'm very, very bullish on SpaceX longer term. I don't think you can discount Elon Musk.
Yep.
He's done phenomenally well with a lot of his businesses, and I think that they've got a very large moat around that business. Its total addressable market is astronomical. One thing I would say to people who go, it's overpriced. There's no way it's worth what it is. I think what's built into that valuation is an option. There's an optionality on. There's a lot of what ifs around SpaceX. What if it does build data centers in space? What if, like, a lot of analysts are saying that SpaceX is really an AI play. They bought a business called I think it was uh, con, I can't remember, Concourse or something like that. That's kind of similar to Claude from Anthropic. So there's really a lot of what ifs with it, and if they do deliver on a lot of this business. I mean, I read, Morgan Stanley put out a report a couple of weeks ago saying they believe that that SpaceX could have $1 trillion in revenue in 2030. I don't think there's a business around today that's got $1 trillion in revenue. In 2030, they're saying 3.4 trillion. Now, there's a lot of it's got to thread the needle on a lot of this, but to just listen, I'm not going to say that based upon its current revenue that it is not. It's if you look at using traditional valuation metrics, you're going, this is insane. It's way overvalued. But I don't think you're buying it based upon its revenue today. You're buying it on this total addressable market that could be in the multi trillions. So still very bullish. SpaceX longer term, absolutely. I
Yep.
mean, there's a lot of noise around it today. It's first earnings. I think I just read today's August 4th. There's still going to be a bunch of volatility around there. There's going to be some shares that the insiders will be able to sell, which is going to add to the float, which could be potentially negative. Who knows? But I think if you're an investor, which we are,
Yep.
you shouldn't be overly concerned with what's going on with the volatility of a stock today.
Yeah, that makes a lot of sense. It is interesting to have all of the hype around this and to really have people review the S1 and SpaceX declared the TAM for the market was $26 trillion or something like that. Like numbers that 20 years ago seemed made up. Like no one
Yeah,
talked about trillions of dollars. It was a hyperbole. And
unpredictability. Yeah,
right, yeah. And now it's a thing. It's an actual market. And I think that the nerd side of me looks at it and goes, AI data centers, cool. No one's doing that. Potential building a moon base so that they can do space exploration, launch the mission to Mars from the moon, because they don't have an atmosphere, they don't have gravity,
Mhm.
so to launch from there would take less energy. That's cool. And then Starlink, they already have Starlink, and it could become um, a major player in telecommunications and take on, what do you call them, terrestrial cell phone companies
Yeah,
and communications. I mean, it does things that other companies don't do. So I think there's a lot of areas in which that umbrella company can really
yeah. I didn't
dominate.
even bring up the direct to satellite cell phone service. Who knows uh, what's in their plans if they offer a cell phone service directly to the consumer where they don't need the earthbound infrastructure to deliver that. That's another market that they could potentially get into. So there's just a lot of unknowns with this company right now.
Yeah, very true. So people who were invested in the fund and saw the peak of the valuation right around IPO and they wanted to hit the sell button, like Jim Cramer, sell, sell, sell. How does that work in a fund like yours where we bought in a very specific way, you're early investors, it was not publicly traded? How does the exit of a fund or a position like this work and what does that typically look like?
Yeah, that is a great question, and I think this will be more of an educational comment because a lot of investors who are not familiar with private assets and how they operate and how do you exit once they become publicly traded. A lot of people, I'm sure, are saying, "Why didn't you sell? Why didn't you sell?" And it's like because we can't. So there's being in a company before the IPO. And we were I'll just give you an example. We were in a company, we got into an IPO round on a stock back in last year. And if you get into that IPO round, you can sell it whenever you want, right? So when SpaceX were raising, I think they raised $75 billion in that IPO round. Now, if you had got into that round, you could have exited whenever you wanted. We were not part of that round. We were, because we've held it through a general partner for over 5 years. Our general partner is considered an insider, and traditionally insiders have to hold their shares for 6 months before they are allowed to sell. So we're part of that, even though how we got access is through a general partner. They've got rules and regulations around when they can sell. Now, with SpaceX, it's a bit different. Where most companies that IPO, if you're an insider, it's a 6-month hold, and then you can start disposing of some of your shares. There's more of an accelerated exit period for insiders of SpaceX. I believe the first one is going to be sometime in August. There's going to be shares unlocked, and all the way, I think uh, there's going to be something like 50% of the shares will be able to be sold from insiders. And I'll qualify what I mean by insiders. So, well, Elon Musk holds about 42% of SpaceX shares. I don't think he's ever going to sell any of that. So there's always going to be a float, what's going to be publicly available to trade is about 58% of that market cap. Of that 58%, let's call it, don't quote me on this, but about 29% of those shares will be disposed of over the next 6 months. The balance of that will be sold 6 months after the IPO price. So there's kind of an accelerated exit period for insiders, and we're going to be part of that. So we do expect to see equity return to us over the next 6 months, and I suspect by the end of 6 months, and it is at the discretion of the general partner. If the general partner believes that that SpaceX has sold off too much, or whatever reason, and that they think that there's a lot more upside, then they won't sell it. And so we're really at the I don't want to use the word mercy, but we're at the it's up to the GP to decide when they want to sell, and when they want to sell, we will have that cash returned to us, and which will lower our exposure to SpaceX. But I think long term, I think we will still have some exposure to SpaceX in our public portfolio. It's a long term hold. You kind of buy it and forget about it. Yeah.
Yep, makes sense. We've had a few other ones that were in the hopper, in the pipeline, that we had talked about last year that were potentially going to IPO this year. And I don't know how many of them are still sort of in alignment, but one of the big exciting ones that seems to get used on a daily basis is Anthropic.
Hmm.
I'm a Claude guy. I really, really like partnering with them to do research and to do other things, simplify my life. What are you guys hearing on your side about the potential for Anthropic still IPOing this year? What are your thoughts on
Yeah,
that?
I'd heard, a couple months back, I'd heard that they were targeting or guiding to sometime in November. Now, a company can guide to when they're going to IPO, but if the market is not really conducive to IPOing at that period, then they will delay it. So I would say I if I was going to bet, I would say anywhere between November and maybe within a 5 to 8 month period, we should see that. I'm glad you brought up Anthropic, is because we do have some exposure to Anthropic, and then just recently we got into a co-investment with one of our managers, and they gave us access to co-invest directly in Anthropic, and we did get about $20 million exposure to to Anthropic. So that's now part of our strategic growth pool as well. So I think I'm very, very optimistic on Anthropic. I mean, its growth rate has just been, I don't think there's any company in history that has demonstrated the sort of revenue growth that this company has. It was growing. I don't know what it's going to be this come out this quarter, but it was essentially growing at 40% a month, not a year, 40% a month. And
Yeah.
yeah, it's a phenomenal company.
Yeah. I really enjoy it. I've got the team trying to learn it, and I'm learning about it as much as possible, how to integrate it into, operations and simplifying my life. Um, but maybe if we could rewind for a second. So
Mm-hmm.
the idea and the concept of co-investing is
Mm-hmm.
totally foreign to most people who,
Mm-hmm.
um, you know, there's concepts of dollar cost averaging and buying indexes
Mm-hmm.
and, stock selection, what goes into that. How is co-investing different from traditional investing that normal people have access to?
So co-investing is, and you're usually offered co-investment opportunities through or a general partner or a fund that you already own. And I'll give you an example. So we committed to a UK based growth equity venture capital fund back in late spring, and they have Anthropic in the fund. So uh, with a co-investment opportunity, let's say that fund manager says, uh, I'm going to invest $50 million in Anthropic to increase my exposure in my fund. But I actually have I've been given access to $150 million of Anthropic. So what they'll do is they'll take 50 million, invest it in the fund, and offer their other limited partners, which we are, access to uh, to that standalone investment in Anthropic. So typically, what if you how it works with funds is that if I've got for every $1 million that I invest in their fund, I'm offered $1 million in co-investments per company. So if that fund has 10 holdings and I commit 10 million, I essentially have $100 million in co-investment opportunities. And the economics on co-investments tend to be better than the economics on a fund. And that's why you look at a lot of very large pension plans and institutions, they will invest in funds as well. And you go, well, why would they invest in fund? In funds, they've got a really large investment committee and research. The reason they do fund investments is to get access to co-investment opportunities where they maybe not have the relationships that a lot of these venture capital guys have. And in fact, I just got an email last night as I was lying in bed from a firm that we've been chatting with, and they've offered us a co-investment opportunity in a company that I'm really, really interested in, and timing might not be the best. And so I've reached out to some other folks in the industry I know, just asking about what their thoughts are on this particular. I'm not going to mention it, but I think
Yeah, yeah.
it's a really
I
interesting.
want to
Actually,
know, but I don't want you to say it.
we'll talk about it offline. Its last market valuation was 7 billion, and they're raising capital at 13 billion right now. So
Okay.
um, yeah,
Very cool.
yeah.
Very cool. So co-investing is something that you get access to, not even as like a product, but as a benefit of relationships and as a benefit of the system that
You've got to have
manage.
pre-existing relationships with these managers to get access to some of these companies. Like Anthropic, it's probably the most in demand company in the world right now. There's a couple of others that have large demand, and it's, if you don't have those relationships, you're just not going to get access to it. Yeah.
Yeah, very true. Some of the other companies that we've talked about, and I don't know kind of where they are in the pipeline, but they were really exciting to me was like Anduril. Um,
That
the
was one of the
founder.
ones when I was thinking about the demand for companies.
Oh yeah,
There's one that's really uh, huge demand for that company as well. And we always keep our eyes out. When are they doing their next capital raise, or maybe we can get an inside round where, for example, this company that I'm not going to mention the name right now, the GP that we invest with, they got. I asked him. I said, "Listen, any idea?" And by the way, the email I got last night was from a different company.
right.
The one we got Anthropic exposure to, I said, "Are you going to have any co-invest in this company?" And he said, "Oh, I just did an inside round." And when you see, because we always hear about, Anthropic is raising capital at a $900 billion valuation, or 300 billion, or whatever it is, and you get in on that round. Well, a lot of these GPs who have been in the industry for decades have a lot of relationships, and they get access to inside rounds. What does that mean? Is So he said, we just bought shares from the CFO. So it's buying shares from insiders who want some liquidity on their shares, and typically they buy it at a discount. So
Okay,
yeah, I forgot your
cool.
question. You would ask me.
That's okay. I
Yeah.
was just asking a nerdy question because I like the
Oh,
company,
Anduril,
right?
you brought up Anduril. I mean, we're talking to another firm that's got it's more of a venture capital firm, but they focus on uh, defense, where Anduril fits in, right? And I think that that's a real growth opportunity over the next God knows how many years, is defense tech. And that's where Anduril, yeah, I would love to get some exposure to that as a co-investor. I think there's strong growth aspects of that company, that, again, it's one of those that's really hard to access right now.
Yeah, gotcha. Maybe if we change gears a little bit, is there's other parts of the portfolio that you guys do very well that would be considered boring, especially in comparison to
Mhm.
these ones that we've been talking about. But boring is good for the portfolio.
Yeah.
Do you guys have anything new in the infrastructure space or on the side that's sort of slow moving and but stable?
We just committed to a royalties fund in our strategic income fund. Um, Royalties, pharmaceutical royalties, medical royalties, does have music royalties. You're basically buying a revenue stream of cash flow, right?
Yep.
Very secure, or historically they've been very, very secure. We committed to that. We're actually, and I'm not going to mention the name of it, but there's some unbelievable infrastructure managers out there, and there's one that we're going to commit a very pretty sizable percentage of our real asset pool to. And this is, when I throw these numbers out, I'm going, listen, if it could do that negative -6% over the next decade, I'll be really, really happy. But this is and once um, we're going to commit to this. Our capital will probably, going into the queue, because the demand for this is so strong that you actually have to go into a queue before your capital gets called. And as we've been guided about 6 to 9 months, and this has historically done 18% since inception. And go for infrastructure, the
Right.
core, value add or core plus. Wow, this is phenomenal, and this will be, we suspect, a core holding of our real asset pool, and so it's going to be a while before we get it, but we're very optimistic. Um, I'm very optimistic on a lot of areas outside of public equities, outside of private equity and venture cap, and huge. Yeah, I really like infrastructure. There's so many areas within infrastructure, and they're great offsets to the public markets. When you think of airports, what do you mean? You can get access to airports? Yes. One of our funds that owns a big part of the Sydney Airport in Australia, Manchester Airport Group, Vienna airports, container ports, toll roads, bridges, utilities, etc. These are areas, our assets, even in a inflationary environment, will do well because a lot of their cash flow is contracted cash flow, and they have inflation riders, so that as inflation increases, they're able to increase their rates as well. And there's very few asset classes, publicly available asset classes, that will do well in an inflationary environment. So you have
Right.
to kind of move over into real assets. Even agriculture. If you think of agriculture, right, food prices go up. Those guys benefit from rising inflation. So yeah, there's a lot of areas today that I'm extremely excited about. Those are real assets. I know you asked me, are there any things you've committed to? Even in our strategic income pool. And if anyone's looking at the performance of the strategic income and real asset pool, performance has been, definitely not as strong as I had hoped over the past year. A big part of that is being, we hedge the US dollar exposure in our strategic income and real asset pool, which has had a pretty sizable impact. When you're hedging, there is a hedging cost, and
Yep.
that certainly had a negative impact given how strong the US dollar has been. It's, as interest rate differentials increase, the cost of that hedging also increases, and that's had a negative impact. But we committed to a European private credit fund. We're looking to gradually move away from just pure U.S. direct lending into more European and possibly Asia-based
Okay.
direct lending or private credits, and we made a commitment. We haven't had any of that capital called yet, but we're always looking at new investment opportunities out there to help, number one, potentially enhance returns, but number two is really diversify where we're seeing that cash flow coming from.
Awesome. I love that. I mean, it's not as exciting as some of the other things that we've talked about, but
No.
it is core. And you think about it when you're out and about in your daily life or you're traveling, all of these pieces that you've just talked about, they're integral to our very convenient lifestyle in North America, whether that's ports for all of our items that we're buying instantly online and we want them to ship to us, and we want to travel and we want to like see things.
Yeah,
We experience, we
I
benefit.
just wanted to. I'm actually working on a a document today, just showing the diversification of. I'm trying to find it here. The diversification of our strategic income pool. I'm just going to read this off to you. So, the typical investor in Canada has got bonds.
Yep.
It could be corporate bonds, it could be Canadian bonds, it could be provincial bonds, but the one thing in common to all of those is they're sensitive to interest rates. If interest, just take a look at 2022, interest rates started going up. Didn't matter if you had Canadian bonds or a Manulife bond, they were down.
Yep.
And private credit was up actually in 22. And you go, well, why did that happen? How could that happen? It's because private credit, it tends to be a floating rate. So as that they use SOFR, which stands for the secured overnight funding rate. As that's going up, the yield you're getting goes up as well, which is because public bonds are, the price could go down given rising inflation rates. You don't really have to deal with that issue. So I'm just looking at the portfolio construction of our strategic income. We've got direct lending, residential mortgage, specialty finance, structured credit, CRE debt, royalties, infrastructure debt, cash and money. So and cash and money market. So it's so diversified amongst a number of different asset classes where maybe one of them doesn't do as well one year. There's others that are going to make up for that. All right.
Yes. Very cool.
Yeah.
I think that's a huge. I think that is a huge benefit, and it was tough being an advisor in the way that I was an advisor. All right, I was a mutual fund licensed advisor in 2022, and my whole career teaching of how to build a portfolio didn't work. Nothing was working in 2022. It was extremely frustrating because there was
Yeah.
no right answer.
There was literally no place to hide in the public markets. When you get rising inflation hits both stocks and bonds. There was literally no place you can hide unless it was
Yeah,
cash.
yeah,
Yeah.
yeah. Fantastic. Before we hop off, is there anything in the pipeline that you're excited about in the second half of the year that maybe you're waiting to materialize, or something that you're waiting to take advantage of?
Well, I'm always waiting for, especially on our private, holdings on the VC venture cap or private equity. It's always exciting when something you've been holding for a while eventually IPOs and you see the benefit of that. Now, I would caution everyone to say, I just don't think, SpaceX was just an outlier for us. I don't think that's going to happen every year.
Right,
Um, you know, but there are Databricks. We've got exposure to Databricks. That
right.
probably going to IPO next year by all account. From what I'm hearing, I think Anthropic could be a really, really nice one for us eventually when that IPOs. We're working on a secondary deal, and once it closes at the end of September, I'll be able to talk about this deal because in next time we get together, it's a really, really interesting secondaries offering from a large China-based insurance company. And this is going to be, I think, quite accretive performance at some point. It's just I'd love to talk about it, but it hasn't closed yet. And I think it's when I talk to you about this, you're gonna go, wow, this is really, really interesting. So, yeah.
Excellent. Maybe if we could drill down just on the language a little bit. So, like, for people who don't know, what is a secondary?
Okay.
How
Yeah,
does that
that's a
work?
good point. That's a great question because I make the mistake that everyone knows all this jargon. A
That's okay.
secondary A secondary offering is typically when an investor. So we can, for example, let's look at ourselves. We own. I'll just use one of our primary funds we own. We own the North Haven Capital Partners 7 fund. North Haven is a Morgan Stanley fund. If we wanted to sell that, we could. There's always a market for these. We would sell it to a secondary investor. Right. So So in this circumstance, it's a large insurance company that owns. They're an investor, and they're a very large investor, just like we are, but they're much bigger than we are. And they've got about $750 million or so in primary funds that they're looking to sell. And they'll be selling them at about a 25% discount to fair value. Um, Now, there's lots of reasons why firms want to sell some of their exposure, and it's not because they're poor funds or they're bad funds. There's lots of reasons, like why an institution is going to get rid of and sell a bunch of their funds they own. It could be a new CIO coming in that's just getting rid of everything that the prior CIO had. It could be because they're overweight private equity, and by their mandate, they're actually forced to rebalance, so they're forced to sell. Yeah, there's a ton of different reasons. This one is a very interesting reason, which I'll tell you at a later date. So it's going
Yeah,
to be pretty interesting. Yeah.
fantastic. That's cool. So secondaries, essentially, it's a way for like institutional investors to move in and out of something, but it's not publicly traded. It's not listed anywhere. You can't
That's
Google it.
right.
You have to know
Yep.
somebody in order to get
You,
this.
yeah, it's basically a way for investors in private funds to sell their exposures. Now, if I'm forced to sell, I'm selling at a discount, right? And in
Yeah.
some cases, it could be a 25 or 30% discount to what the fair value is. So, as a buyer on the other side, that when you're buying assets from a large institutional investor, um, you know, I'll say, okay, I'll buy this, but I'm going to buy it at 75 cents on the dollar or 80 cents on the dollar or whatever, depending on the quality of the underlying holdings.
Yeah. Makes sense.
Yep.
Love this stuff. I mean, this is really what clients that work hard for their money, they make lots of money in their job. We need their portfolio to do some really good things, to operate and get them into spaces. And I think this is the way, institutions and wealthy families invest
Oh,
in
yeah.
order to follow, Warren Buffett's rule number one is don't lose money. And I think that this is a really good platform and portfolio management style in order to kind of maintain that. As like, don't lose money is category number one, and then
Mhm.
find areas of unique growth. I think would be area number two.
Just one thing came to mind just before we drop off. We invested about 4 years ago. I think it was 4 years ago with a firm out of the UK called Henderson Park. It was a pan European kind of opportunistic real estate fund. They invest in shopping malls and hotels. They're the ones that bought even though it's pan European, they had an opportunistic sleeve, and they bought the PGA National last year down in Palm Gardens, Florida.
Yeah.
Um, but they had purchased. They had two malls. One of them in Glasgow, the largest shopping mall in Glasgow, which I believe that they're shopping around. No pun intended. And the other one is they bought a large mall in Madrid, a shopping mall in Madrid. And typically they look to hold them for 4 years because they throw a lot of debt capital in to refurbish the place or the mall or the hotel or whatever they have. But they had such a great, they owned it, they bought this mall in Madrid, and the intent was to hold it for 4 years, but they got an incredible offer and they sold it after just 2 years. And they happened to do I think they more than doubled their money in a two year
Wow.
period. So though that's not going to happen all the time, but when you are, like I always say to people, when you're investing in private assets, doesn't matter if private equity, venture capital, private real estate, or whatever, you need a bit of patience because sometimes it just takes a bit of time for those things to come to fruition. And I would say that on our real asset pool, we've got funds from 2019, 2020 that have barely started to harvest, quote unquote, harvest, that's the term in the industry, or sell any of their assets yet. And historically, we do see things when they're eventually exited, that they're exited at a premium to what they're currently valued at. So I'm pretty optimistic if we start seeing more exits over the next couple of years, that will translate into higher returns for our funds going forward.
That's fantastic. I'm super excited about that. I really like what you guys are doing. I like how it's being done, and I think it tells a really good story as an alternative, especially to the index and forget it mentality that's out there. I'm concerned for a lot of investors that they buy the social media taglines and it sounds good, but it could really hurt them, especially when you're dealing with substantial amounts of invested money
Mhm.
per family. So I really, really like working with you. I love doing these chats.
So do
Thank you
I.
so much for coming on. I really appreciate this.
My pleasure. Really appreciate it,
All
Chris.
right.
All right. Have a good
All
one.
right. I'm Tyson Nagasaka. This has been Investment Chats with Brent Smith, and I'll see you guys on the next one.